Hello and welcome to our discussion on design choices in multi-factor investing. My name is Adam Willis. I'm the head of index and multi-asset distribution at Legal & General Investment Management. Factor-based investing has been a steadily growing area of interest from investors. We see this in terms of asset flow, but we also know anecdotally that investors are increasingly asking us for our opinion on factor-based investing and the best ways to implement that in a portfolio. As investors become more comfortable using these tools in a portfolio, we see evidence of increasing levels of sophistication among investors. We see this in evidence in terms of investors going directly to multi-factor portfolios, but we also see evidence of investors looking at completion portfolios to complete their exposures using factors. In addition to this, we have the index calculators moving things at an incredible rate of innovation. We see new portfolios, new solutions coming online all the time, and this means that the product universe is incredibly complex for investors to navigate. All this means that design choices are increasingly important for investors, and investors would do well to consider design choices first before looking at product. Now today, to discuss the topic, we have Aniket Das, Senior Investment Strategist at Legal & General Investment Management, and Eric Shrabini, Global Research and Investment Solutions Director at ERI Scientific Beta. Aniket, I wonder if we could start with your thoughts on design choices and how they should feature in what investors need to care about.
Sure, Adam. I think you mentioned it right there. There's been an increasing proliferation of factor-based products out there in the marketplace, and it's getting increasingly hard for investors to make sense of that whole universe that's coming online. Now multi-factor investing, as you've mentioned, is the latest area of innovation. We're seeing a lot of clients embrace multi-factor investing, and the concept is really simple. You're looking to diversify the risk of a single factor underperforming by investing into a number of different factors with different characteristics. That sounds great in theory, but in practice, there's so many design choices that need to be made and investors need to take care of. A real kind of illustrative example comes from a client of ours who invested a few years into three different single factor indices, and they've gone with value, quality, and low volatility as three very kind of well-known single factor indices to invest into. And what they decided to do was to just put equal amounts of weight, capital exposure into each of these three different indices to give some kind of balance. And that seems like a good starting point, but the problem really for them was that one of these indices was very diversified. It held lots of stocks, and it took quite kind of small positions in each of these stocks, whereas the two other factors were very concentrated. These indices carried lots of factor exposure, whereas the first carried low levels of factor exposure. So when blending them together, they weren't really getting equal amounts of risk exposure coming from each of these indices, and that's definitely not what they intended. So as a result, what you've seen is just by putting naively three factor indices, that doesn't necessarily give you the result that you're looking for. And additionally, when you look at what the client was invested into, two of these factors scored poorly on the third factor. So you had factor interaction. So that again speaks towards not getting a risk balance across the three. And finally, for this client, one of these indices had significantly underperformed the other two. And as a result, they drifted away without taking any action from having the equal weight balance. So for all these reasons, it just highlights the challenges in multi-factor investing. It's not as easy as it looks like. So just through this example, we can see the real challenges involved in designing a multi-factor strategy and managing it through time. And we can broadly segment these design choices into 6 different areas. Firstly, we have factor selection. Which factors do you want to invest into and why? Next, we have the starting universe. So which set of stocks are we going to invest our factor-based strategies into. Which pool of stocks? Is it going to be developed? Is it going to be emerging, US, Europe, etc.? Then we have the multi-factor construction approaches. We'll get into this a bit later, but there are a number of ways we can construct a multi-factor strategy. Then we have the stock weighting scheme. So once we've decided on which stocks we want in our multi-factor strategy, how are we going to apportion the weight to each of these stocks? Then we have the factor weights. So we've decided which factors, but how much weight should we give to each one of these individual factors? Then finally we have the region weights, sector weights, and currency exposures. These are areas which are often not deliberately thought about. They tend to be outcomes rather than anything deliberately targeted. But we definitely feel like this is an area that investors need to focus on as it can seriously affect outcomes.
Thank you, Aniket. Eric, Aniket has just laid out very nicely what I think is a framework to approach design choices when you approach multi-factor investing. Can you talk about the way that ERI Scientific Beta may support that?
Sure. Yes, I think Aniket has mentioned the very important choices investors need to make. In terms of design choices, we start right at the top in terms of thinking about an investment philosophy. What is it you're trying to achieve? Our investment philosophy is very much based on a risk-based approach. Risk is something that you can measure, something that you can do about, something that you can control. So our design choices and our investment philosophy is very much risk-based. And the important risks are, as Aniket has already highlighted, is to decide which factors to invest in. And then after that, once you've decided the factors, so those are the desired risks, you need to think about the undesired risks, which you can mitigate by the stock weighting schemes to reduce the unrewarded risk. So you diversify away stock risk. And then thirdly, you have another level of diversification that Aniket referred to, which is diversification across different factors. So that's the investment philosophy. How does that translate into an index design methodology? Well, in terms of index design, ERI Scientific Beta uses a consistent index design approach. And this is very, very important to us for two reasons. First of all, if you have a consistent index design methodology, it avoids the problem of data mining. It's going to be much, much more robust if you don't get tempted at looking at the recent past in terms of what's going on. If you design an index in a consistent manner, you avoid, number one, the problem of data mining. When you build a framework as well, there are also a number of choices. It's not just a question of a single choice. You have different choices within the framework as well. And that also then gives you something in terms of robustness, in terms of understanding how sensitive the strategy is to different choices as well. So in terms of index design methodology, just to wrap it all up, what ERI Scientific Beta does is it applies its methodology within each region on a regional basis, because what we're trying to do is select the securities. We're not trying to take regional bets. So the first thing we do is within each region, we choose the largest and most liquid securities. After that, we tilt towards the desired factor using stock selection. So we select the companies that are exposed to that factor. The third stage then is what weighting scheme do you apply to the stocks? Diversification, we offer a number of choices there. And then finally, once we've built single factor indexes, we combine them to a multi-factor approach by combining the factors within the region. And I know that Aniket has done a lot of work in terms of the choices that we offer to see how sensitive the strategy is and whether it's robust or not as well.
Thank you, Eric. Aniket, Legal & General Investment Management launched a multi-factor strategy in July 2017 in partnership with ERI Scientific Beta. The strategy now has over $1 billion in assets. Can you talk about how the design choices that you've just described featured in this product?
Sure, Adam. So as Eric has nicely mentioned, we had to put a lot of thought into what we were doing when we started the multi-factor strategy, and we took what we would call a blank sheet of paper approach. So really we're coming at it with no preconceived notions. We're starting from the ground up, and from that, what is a theme that we have as a philosophy? Eric mentioned our philosophy in a number of funds that we run is the power of diversification. So that was no different in the case of the multi-factor strategy. When we're designing it, we want to diversify as much as possible across a number of different dimensions. And so that was the philosophy that we began with. From there, we looked at the prior research, what was out there, and we thought about what we needed to do for research internally. And nicely, we were able to come out with what factors we needed to achieve an appropriate level of diversification. Then thinking about the starting universe, what set of stocks did we want to apply that on? And then we come to the multi-factor construction approach. This is where we had to do a lot of work in understanding what the latest innovations were out there in the market. And you'll often hear these terms being thrown out: top-down way of multi-factor construction, bottom-up way of multi-factor construction. What does it mean? What are the pros and cons of each? And why would you choose one over the other? So we had to do a lot of internal research on this point. At the same time, ERI Scientific Beta, they came out with a new innovative approach which took the simplicity, the benefits of the top-down approach, while overcoming one of its key weaknesses, the factor interaction between the different factors, which I mentioned with the client of ours earlier. So Eric will talk a bit more about that point, I think. But that was definitely an area where we had to do a lot of empirical testing ourselves to validate the claims being made from proponents of top-down, proponents of bottom-up, and then the claims made by ERI Scientific Beta. After doing those pieces of research, we still had to do work on exactly what stock weighting schemes we wanted to have, and again, we chose to diversify across different diversified weighting schemes, as Eric mentioned, and that also actually leads to more diversified sector weights, which is a nice outcome that we like. Finally, in terms of the factor weights, we were seeking the risk balance that our client actually at the start was seeking, but we did a lot of work to confirm that we are getting a nice risk balance coming from the factors that we're targeting. And that from that point on, the asset allocation team that manages this strategy at LGIM, they thought about the regional exposures the strategy takes and the currency exposures. Region exposure and currency exposure, as I mentioned earlier, quite often tend to be an outcome rather than anything explicitly targeted within a strategy. We think that it's really important that investors pay attention to this, because region exposures can, as we've seen in the past few years, really affect end outcomes that investors get. So there's explicit concern given to this. And what we're really trying to achieve is diversification across regions. Diversification runs through everything that we're looking at, and that same is for regions. So why do we not want to allocate more than half our assets in North America? Because we think on an absolute level, that's a very high level of risk. So we're generally looking to spread the risk out. And on currency exposures, you often see equity markets correlated with the base currency of an investor, and sometimes highly correlated, sometimes lowly correlated. We can actually harness the correlation or decorrelation in order to reduce volatility that the investor is getting. And we think that's a fairly attractive feature that a lot of investors care about. So overall, having thought about all these different elements, we're able to really, at the end of the day, clearly message to investors the outcome that they can expect from our strategy. And that is to achieve performance better than a regional mix of market cap indices over the long term, while having a level of risk lower than that mix of regional indices. That's the outcome that we definitely feel that investors should be able to achieve with our strategy.
Thanks, Aniket. Eric, Aniket mentioned two innovations, top-down, bottom-up, and what that debate means. And he also talked about high factor intensity and what that innovation is from ERI Scientific Beta. Could you describe both
Sure.
at a high level, please?
Okay, so top-down versus bottom-up. Top-down means you build single-factor portfolios together first, and then you combine those single-factor portfolios into a multi-factor product. Bottom-up means you go right down to the stock level and you look at the multi-factor scores of individual securities and you build your portfolio from the bottom up using stock level information. So that is top-down and that is bottom-up. So that is to address your first question. In terms of the second question, ERI Scientific Beta uses a top-down approach. Now, when you use a top-down approach, you are investing in one single factor at a time. And what Aniket has already told us is that when you invest in a single factor, you may also get interaction between the other factors. And unfortunately, that interaction works against you because you're investing in uncorrelated factors. When you invest in one factor, you may be getting negative exposure to another factor. So that interaction effect doesn't work well for you in a top-down framework. So the way we've addressed this issue at ERI Scientific Beta is by introducing what we call a high factor intensity filter. And the objective of the filter is actually very simple. All we do is when we design a factor index, we simply select the stocks that are exposed to that particular factor, and then to avoid the negative interaction effect, we simply remove the stocks that are causing the negative interaction effect. That removal of the stocks is essentially a filter, and we filter out the stocks that have low and negative exposure to the other factors. So when you then put these single factor portfolios together, you avoid this negative interaction effect. There are two benefits to the high factor intensity filter. Number one is you are better off removing the stocks with a negative exposure to the other factors, taking out these stocks that cause the negative interaction. Because the negative interaction is twice as important as the positive interaction. So you're actually better off taking out the stocks that have this negative interaction effect. And secondly, you're still left with a broad portfolio, and that broad portfolio you can then diversify away stock risk. Aniket has mentioned the diversification of the stock risk several times, and the reason it is so important to diversify across a portfolio is from the point of view of robustness. No one knows what's going to happen to a particular factor over any period of time, but what you don't want to happen is you don't want to be caught out either one way or the other. And the way to avoid being caught out is by diversifying across those stocks. Once you've removed the stocks using the filter, you still have a broad enough universe to diversify and create a more robust factor with very little interaction effects when you combine them. So that's the filter.
Thank you, Eric. Aniket, we've covered a lot of ground. Design choices is a complex area as we've described. Can you please leave us with some key takeaways?
Sure. I think the key one for me really is that investors need to look beyond the names of a strategy. They can't simply rely on something being multi-factor, giving them the outcome that they want. They really do need to do a bit of homework around what they're investing into. Of course, they can go out and do it themselves, as our client tried to do, but you really have to have the governance in place to achieve that if you're going to try and do that. Otherwise, look for a reputable manager to do that for you, essentially, one that has thought about each of these design choices and how that can affect the outcome.
Thank you, Aniket. And Eric?
Two key takeaways from us. First of all, an investment philosophy based on risk control. Keep the risks that will reward you well over the long term. Reduce your exposure to unrewarded risks. So first of all, an investment philosophy based around risk control. Secondly, in terms of index design, we think index design is all about robustness. You can generate robustness through a consistent index design methodology and also through diversification of unrewarded risk. So those are the two key takeaways for us.
And that draws to a close our discussion on design choices in multi-factor investing. We hope you found it useful. Thank you, gentlemen, for your time.
Thank you.
Thank you.
Thank you, Adam.